All right, for those of you out there that are Team Zuck, well, this video is for you. Now, Facebook as a platform might have seen its best days, but look, Instagram, that is still a beast of a platform. And I think this one's actually going to be pretty hard to figure out the future growth rates. Like, I don't know what it's going to be for Meta in the next 5 years, because will they be generating huge money from virtual reality? Will Instagram be monetized far better than it is today? Or will something like TikTok and Twitter start eating into their ad revenue? Well, let's try to consider all of this and get a good feel for a fair stock price anyway. So the most difficult thing we have to do first is to try to figure out the future growth rates. So what I'm going to do is I'm going to look at the past growth rates. I'm going to read the annual reports and things like that and see what's coming along in the pipeline for the future for Meta and get then a feel for what I think they can do moving forward. So to calculate the historical growth rates, I just look at the past 5 years. So we go from 55 to 120 for revenue, 55 to 120 in the past 5 years. And that will tell us that it's grown at about, looks like 17%. Then I'm going to take a look at the gross profit. So we've gone from 46 to 95. And so we're at about 15, 16, somewhere around that. Okay. So then I want to look at the cash from operations, and we've gone from 29 to 55 in the same period. So 29 to 55 in those 5 years. And I'm going to calculate that at around 13 and a half. So we've somewhere between 13 and a half to 16 and a half, 17, somewhere in that range. So 15% looks about right. Now, if I do have a look at this a little closer, especially if I look at the revenue, I can see that it was growing at like, what's that, 50%, 47%, 37, 26, 21. It has been declining. There was a big jump up in the pandemic because obviously everything went nuts in the tech world. Everyone was sitting on Instagram. So it grew a lot that year. And then we had a bit of a return to an average where the iOS update. So advertising revenues dropped off quite substantially. So we're probably looking at a slower growth period as well coming up. So those days of the 50s to 20% plus per annum growth might be behind us. They might find new ways to grow, but that's going to be quite a challenge. And I don't really want to invest in a company that might go back to these levels. Let's just try to figure out somewhere in the middle. 15% is what they have been growing at. I want to give it a little bit less than that. I'm going to say just 10% per annum. That keeps them in line with, say, Apple, something around that. So I'm not going to give them a whole lot of credit for any future big wins that they might have. So that'll just be more luck than anything. So when I look at my growth rates here, I'm just going to use 10% throughout for the next 10 years. And I feel like based on what I think is coming, but I just think there's a lot of competition in the space for ad dollars at the moment. I haven't seen much traction in their virtual reality stuff. Yeah, I know they're going to probably do something impressive, but maybe they have a couple of flat years and then a couple of big impressive years. And I still think that's only going to average out at about 10% anyway. So let's go with that for now. I don't think I want to be too much more aggressive than that. I could play around with, say, 15% for the next 5 years and 10% after that, but I feel more comfortable at around about 10% going forward. So what I've done here is you put that in the growth rates. The discount rate, I've used 10% because that's how we're going to figure out fair value. That's the standard return that I want to get above the S&P 500 and sort of what institutional money would be chasing for the added risk of an individual name. I think 10% is fair. The multiple, 20, it's a good company. If it can grow at 10% per annum for another 10 years, that's going to warrant a pretty high multiple because it's so stable. So 20, I think, is fair. Operating cash minus maintenance CapEx. So what I did was I went to the cash flow statement. I go to cash from operations. And then what I do is I Google Meta maintenance CapEx. And in Guru Focus, they tell you the 5-year average of maintenance CapEx, and it's about 14 billion. So I subtract that away from the 55 billion, and that's how we get to this 42 number. So that's how I figured out it's a better measure of free cash flow than what the free cash flow number it gets reported, because we're factoring in this normal free cash flow number factors in growth capex. So if they're spending lots of money on virtual reality or whatever they've been spending money on, that's something that I don't want to include. I just want the maintenance capex. It's an important differentiator, because otherwise we'd be using something like 2024. So this is, I think, a more accurate number. I've just pulled the shares outstanding number from TIKR as well, total cash and total debt, what I did to find that. I just went to the balance sheet and I scrolled down to I started at the total cash and short-term investments at 54 53, the total debt at 37. And okay, I'm feeling pretty good about those numbers. It tells me that a fair price would be around about $450 a share based on these numbers. So 450. Now, what I want to do is I want to do this again, but in a 5-year valuation model. So we got 450 for my DCF method. All right, what's important to note is that things are going to change here. There's a lot of nuance and research to keep up to date with these calculations. And I'm going to keep track of this in a weekly report that I call Yes Stocks, No Stocks, and there's a link in the description. Now you can get this each week for free, and it isn't some boring newsletter. It's just straight into the valuation. So there's no BS, there's no fluff. I highly recommend you joining, as I've just done a lot of the heavy lifting for you. And just looking at over the next 5 years. So what I did was here in this model, I grabbed the revenue number and I grow that out at what I think it can grow at, which is 10%. The free cash flow margin is just the percentage that the free cash flow is of the revenue. And to figure that out, if it's 0, 35% of 120 is 42, which we worked out was the maintenance capex, the operating cash minus maintenance capex number. So let's grow that out at 10%. There's my future PE, or price to free cash flow number, sorry. They have been buying back a little bit of stock, not much. It's a bit lumpy. Like last year, I think they bought back 5%, but the years before they issued a little bit. And on average, I think it's going to be about 1% buyback rate. So that's -1. Shares outstanding, current market cap tells me that I'm going to get a 5-year compound annual growth rate of about 12% from current prices and a 5-year target price of 550. So to figure out what the fair value is, I want to get this number down to 10%. So it could be 900, 880, at 880. So it looks like a 10% increase to the current price. The current price for me at the moment is 311. So around about 340 is about a 10% increase. So fair valuation is somewhere between these two numbers, I think, somewhere between the 5-year and the 10-year, the DCF and the 5-year valuation. So I'm probably going to call this around about $400 a share. I feel pretty comfortable with that. Somewhere in that range is probably a fair valuation. Depends. If you want to hold this for just 5 years, I guess probably closer to 340 is better. If you're thinking of this for a big long-term play, probably around 400 is getting more interesting. But that's only if you're going to get 10%. So what I want to really get is about 22%. So let's see if I can, what I'd have to pay to get 22%. Looks like around about, yeah, okay, so 520. So if I wanted to get 22%, I would have to, I multiply this number by the current share price, around $200 a share. So if I was buying this at $200 a share, I could expect around about a 22% return on my money over 5 years, assuming that the growth rate of 10% is going to hold up, and we get this price to free cash flow multiple as well. Over here, I do the same thing. What I do is I just put in 22% for my discount rate, and it tells me I want to buy this at around $200. So we got the same buy price for both methods here. So around $200 is a very interesting buy. What did we say the price was at the moment? 300. So it's somewhere between fair value and a good price to buy, something to keep an eye on just in case there's a dip in the market. If we look at the last 3 years, we've gone from nearly 400 down to under 100, back up to 300. So it's been a wild ride for Meta stockholders. So yeah, it's good to do these calculations to get a feel. I'm going to keep this updated regularly, the growth rates, because I might change 10% to 12% or 15% or even down to 5%. And that will affect that valuation quite significantly. And I'm going to keep that in my up-to-date in my weekly report called Yes Stocks, No Stocks. Link in the description below for that. And I hope you've enjoyed this valuation of Meta, and I will see you in the next video.